Hi, I'm Barbara Friedberg, and I am here with Victor Haghani, an old friend and author of the new book, The Missing Billionaires. Victor, would you like to hold up a copy of the book so we can all see it?
Here it is.
Wonderful.
Here's a guide to better financial decisions with my co-author James White, and I don't know how clear that is, and forward by Emmanuel Roman, the CEO of PIMCO.
Wonderful. Well, we're going to dig in. I'm going to have a link to the book and to everything we talk about here below. But before we get started, and Victor has a really long bio. So I'm going to leave it up to him to give you the cliff notes. And we're also going to put a link to his fabulous TED Talk as well, where he talks about the same content.
Great. Well, my background, I was born in New York, and I grew up in the New York area. When I was 13 years old, my father, who was from Iran, who had come to America in 1941, moved our family to Iran, where we lived for a few years until the revolution. And then we left and wound up in London, where I finished high school and went to university, then came back to the States and worked for Salomon Brothers for about 10 years. And after that, at the hedge fund, I was LTCM, I was a co-founder. After its demise in 1998, I took a break for a while to be with my young family. And after 10 years or so, I started Elm Wealth, a wealth advisory firm, trying to help people to get diversified exposure to global markets through low-cost ETFs. And in a tax-efficient and low-cost manner, we charge very low fees. That's part of our whole approach, is to control what we can control and to give people a relatively smooth ride, or at least a supervised ride in the equity market for the long term, responding to how markets are changing over time. I'm sure we'll talk more about that. I live in Jackson Hole, Wyoming, and I have 3 grown children who are out there working and learning, and that's it. The Cliff Notes version.
Wonderful. Now, the Missing Billionaires. I know when we first met, probably 5 to 7 years ago, you said, Barbara, should I write a book? And here it is. I'm not going to say what my recommendation was because that's for another conversation. But yes, you did write the book. And I want to know, why did you write it? And what is the premise?
Well, I guess everybody, decides to write a book, feels that there's something that they want to communicate that's not being sufficiently related to readers out there. And in our case, we look at the investing process as being comprised of 2 parts. One is you decide what it is that you want to invest in. You select your investments. You analyze and comb through different investment possibilities, and you choose what you want to invest in. And then the second part is you have to decide how much to invest in those things, individually and collectively. And this how much question, we felt, just isn't getting enough attention by investors and households. And actually, this how much question, or making decisions that involve risk, it goes beyond even choosing investments. It goes into how you should set your spending policy in conjunction with your investment policy. It influences when you should realize and how much you should realize of capital gains when you're lucky enough to have them. And it goes to so many different decisions that we face in the financial part of our lives, that we felt that a book that really dealt with this how much side of the investing and personal finance set of questions would be really valuable, and that there wasn't anything out there that did a good job of that, in a way that would be accessible to lots of readers. I mean, there's a lot of literature in the academic world on making good decisions under uncertainty. But in terms of accessible books that are out there, most of them are really dealing with this what to invest in question.
Yeah, that's a tough one. And you cover that a lot. And at the end, we're going to talk about the sum up of how do you actually decide not only what investments to invest in, but what percentages. And we call that your asset allocation. And we're also going to talk about 2 ways to do asset allocation. One is your favorite dynamic, and it is based, and the other is a fixed. So we will give you that. Victor is kind enough, for those of us who can't do dynamic allocation ourselves, to give us an idea of how to do a fixed asset allocation. But one of the things that was most impressive that he talked about, we all want to know, what is the future return going to be on our stock market investments? And he gave a guide a really simple back of the envelope way to get a guesstimate. So I'm going to ask you to spend a couple of minutes talking about the 1/the CAPE ratio, which is a fancy way of saying 1 divided by your long-term 10-year PE ratio as a predictor of real returns over the long term. So tell me about that. Why do you think that works? And what the heck is the long term?
Sure. Well, imagine you're buying a building, a commercial building, and you have tenants in the building. Well, and let's say you're not going to borrow any money to own this building. You're just looking at the building by itself, and the rental yield on the building. You're buying this building. Let's say the building costs $100. You'll want to know what the rental income is on that building, and if you know what that rental income is and you have some sense for that rental income, the rental market where you have your building, maybe there's some ups and downs. There was a recession and the rent went down, and at some other time there was a shortage of buildings and the rent you would have been receiving would have gone up, but then other people came in and built more buildings and then the rent stabilized again. And so you're looking at the rent, say over the last 10 years or over some historical period of time. Maybe you're inflation adjusting, what rents were paid on this building, historically. And you're saying, well, okay, that's kind of my estimate for, like, I'm going to call that a cyclically adjusted rental income on my building. And that might be better than just looking at the past 1 year, because maybe that past 1 year was like some recession was going on and your building was half empty. And so you were hardly getting any rental income at all, or maybe you were in a boom time. So that's the reason to maybe look over a longer historical period. So now you have this number, which is sort of the average rental adjusted for inflation that you're going to earn on this building. And let's say it's $5. So you're buying this building for $100. It's giving you $5 of rental income. What do you think is the return going to? What do you think will be the return on this building in the future? Well, the way that you're going to probably think about it is you're going to say, well, I'm getting $5 now. I'm paying $100 for it. I'm getting $5 now. And probably that $5 is going to go up, at least with inflation, I hope, over the long term. And maybe it's going to go up a little bit more than that because there's economic growth and all of that. But maybe on the other hand, there's going to be some depreciation. This building that I'm buying eventually is going to start to be a less attractive place for tenants than newer buildings that are being bought, that are being constructed, with big underfloor spaces for modern AC and all this stuff. And so you might just say, well, I think that I'm going to earn a 5% real return after inflation on this building, right? And so that's exactly the analogy within the stock market. So instead of looking at rental income, we're looking at earnings, and we're saying, okay, I'm going to try to get some idea of the cyclically adjusted earnings power of the stock market. It could be the global stock market, or maybe you're just looking at the US stock market, but a big, broad collection of all kinds of different businesses. And you're kind of making this assumption that the companies can have their earnings keep up with inflation over time. And there's an assumption here, going back to the building, where we're not taking that income and buying other buildings in our portfolio with it. It's just the cash is coming out. So in other words, in thinking about applying this to the stock market, we want to make believe that companies are paying out all of their earnings as dividends each year, which they don't do. They keep a lot of their dividends and reinvest in their companies. But if you would think of the earnings as being fully paid out, and if you imagine that under those circumstances that the company would be able to hold on to market share and grow its earnings with inflation, that would tell you that 1/CAPE, or what we could also call the cyclically adjusted earnings yield, which is just the inverse of 1 over the cyclically adjusted price earnings ratio, that the cyclically adjusted earnings yield is an estimate of the real return that the stock market will give you, the real inflation adjusted return that the stock market will give you over a very, very long horizon, over such a long horizon that we don't care how the PE is going to change when we come to sell our investment. Or you could say we're assuming that the PE stays constant at the time that we would sell our investment, or it could just be so far in the future that it doesn't matter. And so that's really this idea of the estimate. And it's not our idea. This is an idea that's been bouncing around since at least since the 1990s, when Bob Shiller from Yale and John Campbell and other academics, showed that this makes logical sense, and also that historically it seems to work okay. I mean, we don't have that much data on long-term stock market returns because we only have 100 odd years of US stock market returns. But if we even look at those, the data, the historical experience is supportive of this idea that the cyclically adjusted earnings yield is a decent estimate of the long-term real return of the stock market.
And I'll put a link below to where you can find that information on Bob Shiller's website. But also, you dodged a question, Victor. What is the long term?
Well, I would say that the long term is 30 years or more. I think 5 years is not the long term. That if you're buying into the stock market with a 5-year investment horizon, you really have to have the biggest component of your return is going to be how has the PE changed? How has the valuation of the stock market changed over that period? Rather than what have earnings and dividends done.
Perfect answer. And that tells us that we are not talking about a book for traders or short-term investors. We are talking here about the main goal of most of us, and the reason that most of us invest, which is to spread our wealth over our earnings years and to last us until death, which might come anytime, we don't know when that will come. So we're talking long-term investing, and the concepts that are discussed in the Missing Billionaires really relate to investment concepts for those of us who want to invest for the long term. So I have another statement that I pulled from your book, and you and I actually discussed this same concept a couple of years ago when I think it was probably in 2022, when I was saying, Victor, I'm kind of disappointed the stock market is declining, but I'm very happy that at least the Fed is responding with higher interest rates because then I can get a higher return on my cash investments. And the statement that I'm going to ask you to discuss next is from page 62, when the market goes down, and we all know how that feels, horrible. Your portfolio goes down, but the increased expected return offsets some of that loss in value. So your risk is actually less than it appears. Help us understand what does that mean?
What we're saying there, and again, this is not by any means an original idea, is that if you're a long-term investor, what do you really care about? What is it that is important to you as a long-term investor? Is it the value of your wealth as measured in your brokerage account, or is it the spending, the long-term real spending that it can support?
And I've got to interrupt you here because I get that concept. I understand that. Looking at your net worth number, what is it? It's a vanity metric, really. It's like saying for many of us who were brought up with these ideas that money is very important, we think we're valued if we have a higher net worth. So the idea of switching from that mindset into the idea of, well, what does it really support in our lives and spending is a tough call.
Yeah. So, imagine, what would you rather have? Would you rather have, $1 million of net worth, but the only investments that you can make are going to give you a 0 rate of return after inflation and after taxes? Or would you rather have $500,000 of net worth in your brokerage account, but you lived in a world where you could make 10%, hypothetically, you could make 10% risk-free and after inflation and after taxes? Well, how should you answer that question? It depends on your horizon. If you plan to live for one more year and you plan to spend your $1 million you plan to spend all of your wealth next year, you're much better off with $1 million in your brokerage account. You spend the $1 million and you exit. That's great, because you're getting to spend twice as much money as in the other case where you only have $500,000. Like, who cares that you can earn 10%? You're going to spend all the money next year. But if you have a 20-year horizon, let's say, right, then in the case of having the $1 million but a 0 rate of return, that you should spend $1 million divided by 20, which is $50,000 a year. You can spend $50,000 a year, and at the end of 20 years, you have no money left, and that's that. But if you're in this world where you have $500,000 and you can earn 10% a year, you can see that you can spend more than $50,000 a year, because you can amortize, you're able to amortize that 500,000 down. So 500,000 amortized at 10% over 20 years, I don't know, it's probably like is probably, I don't know, $70,000 a year that you can spend. And so you can see that depending on, which environment, so which horizon you have for your life and your investing, the investing environment can be really important. It doesn't matter if you're just going to spend everything in the near term, but if you have a long-term horizon for your spending, then the expected return that you can earn on your investments becomes really important. And so that ties to the question you were asking, where it's like, well, if the market goes down, and let's say the reason it's gone down is that the Fed has raised interest rates, and now real interest rates, as evidenced by TIPS, for instance, by Treasury inflation-protected securities, that interest rates have gone up, so bond prices have gone down, and stock prices have gone down. But it's all because interest rates have gone up. Like, you might actually be happier than before, if depending on what your investments were. If you had some investments in Treasury bills, they didn't go down, but now you can invest that money at a higher real rate. Or certainly, you're not as bad off as it appears by just looking in your brokerage account and saying, "Oh my goodness, my net worth has gone from $1 million to $800,000." But no, as a long-term investor, hopefully you're going to earn a higher return on your investments, and you might not be better off, but you're not as badly off as what it appears to be from looking at your brokerage account. And that's really been the story over these last couple of years. We've had this tremendous increase in real interest rates from -1 to 1.5% all the way up to 2.5%. And sure, equities have gone down and bonds have gone down a lot, but it's not as bad as it looks. And some people are actually better off that have very long horizons and weren't that fully invested in bonds and stocks. I mean, stocks have actually done better than bonds have actually over that whole period. So yeah, I mean, most investors are probably better off than they were to begin with if they have a long-term horizon for their investing. For their financial decisions. They're investing, they're spending, everything, a long-term horizon.
I like that, but what about the people that are in their 20s, their 30s, they're just building up their net worth, and they have been advised, even if they have a higher risk aversion score, many of these individuals have been advised to hold up to 90% of the risky assets and only 10% in bonds. I want your thoughts on that. Is that a good way to go?
It depends. It depends a little bit. I think the argument there is that when somebody is young, that they have a lot of human capital, and they don't have much financial capital. And if their human capital is more like a bond than a stock, then their asset allocation is like, here's all this human capital, which is more bond-like. And then they have some financial capital, which they might as well put all into equities, because then their asset allocation still is very small equities and lots of bonds. Now, it could be that your human capital is a lot like the stock market. Like maybe you work at an investment bank, or I don't know. I mean, there's lots of occupations that have more equity-like, more stock-like characteristics. But the argument is that for most people, their human capital in most professions, in most walks of life, your human capital is quite bond-like. Maybe it's not completely bond-like, but if your human capital is like 50% like a stock and 50% like a bond, you're probably underweight stocks. And so in your financial account, you put more money into stocks until you're older, and things change. And as you're older, hopefully your financial capital has gone up. Your human capital starts to go down relatively because you have less years to work, not because you're not more productive. You're more productive, but just you're going to work for less years. And so
yeah, don't remind me of that, okay? That is what I wake up to every single morning. So looking at that countdown clock. So so as we get to the final sections of our conversation, so what is our optimal spending versus our net worth?
Well, I think the way to start thinking about that in the easiest way possible is like, start off by imagining you're going to live forever. Okay, now you're not going to live forever, and even if you care a lot about your kids and grandkids or whatever, you're not going to be that infinity is just too long for all of us so to be thinking about. But it's a really good way to start the thought process, because then we can move from this very long-term sort of infinite horizon, and we can come back and think about it to the finite horizon of our lives, or our lives plus maybe some family members. And so when you're thinking about the very long term, the question is, what is you're going to be thinking about, like, what's a sustainable spending policy? A sustainable spending policy, what would it be? What would be the definition of it? It would be a spending policy that you could follow for a very, very long time. That's the notion of sustainable. So if you're following a spending policy where your wealth is just going down pretty rapidly, that would not be a sustainable spending policy. That would be unsustainable. So what's quite interesting is, like, imagine that you have your portfolio. You've decided on what you want to be invested in, how much risk you want to take, based upon your personal preferences, and you decide that that you want to have a portfolio. If you were investing forever, you'd like to have a portfolio that would be, say, 75% equities, 25% fixed income, and that you decide that after tax and after inflation, that this portfolio of yours has an expected return of inflation plus 3%, let's just say. Okay, so it has a real return of 3%, the portfolio that you have after tax and inflation. And but it's volatile, it's risky because you have equities in there. So the riskiness of it, let's say that it fluctuates by, let's just say it fluctuates by 15% a year. Maybe that's a little bit high, but we'll just use that number of 15% per year. So now you have a 3% expected return on the portfolio, expected real return on the portfolio above inflation. So what if you said, oh, okay, I think I'll just spend 3% of my, there's the first thing that you might do is you might say, okay, I have $1 million of assets. So 3% of $1 million is $30,000. So my policy is going to be, I'm going to spend $30,000 every year forever, adjusted for inflation. So as inflation goes up, I'll increase the $30,000. And that's my spending policy. Well, if you think about that, and if you simulate that, for instance, what you'll find is that you're going to run out of money pretty quickly. And the reason for that is that while your expected return is 3% after inflation and taxes, your compound return is going to be less than that. And why is your compound return going to be less than that? It's because of the volatility of the portfolio, the variability and the volatility of the portfolio that you have. So, and to give you an example of that, right? Like, imagine that 1 year I make 50% on my money, and the next year I lose 50% on my money. Well, my average return over those two periods is zero, right? 50 minus 50 is zero, divided by 2 years. I made a zero return. But if I invested $100 and I made 50% and lost 50%, or lost 50% and made 50%, I would find that I only had $75 left at the end of the 2 years. And so my return was like minus 12.5% per year. So my compound return is minus 12.5%, even though my average return is zero. And that's the pernicious effect of variability and volatility on compound returns. Now, when, of course, if I just, if I have very little variability in my returns, then the effect is quite small, almost unnoticeable. But if I have 15% variability in my returns, it starts to become noticeable. It's not huge, but it's noticeable, and it adds up to more than 1% per year of reduction of my compound return. So in the case that I was outlining, where the person says my expected return is 3%, the person's compound return is going to be more like just 1.75%. And so if the person is spending 3% as their hoped for sustainable spending rate, you could see that the most likely outcome of their portfolio is going to be diminishing in value. Now, the average value of their portfolio might not be is not going to be diminishing in value, the full range of all the different outcomes and expectations, but sort of the central case is that their wealth is diminishing in the most likely or central cases of outcomes. And so when we think about a sustainable spending rate, the first thing we have to do is take account of that volatility and reduce our expected return by that volatility drag, we could call it, or variability drag, and that becomes more of a sustainable spending rate for us. So in this case, a sustainable rate would be more like 1.75. Now, on top of that, we need to make further adjustments that tend to other adjustments that would tend to push it down would be our degree of risk aversion. If we have a typical amount of risk aversion, that would also push our spending rate down a little bit. But on the other hand, we might have what economists call time preference, positive time preference, where it's like we like to spend, we like good things to happen to us sooner rather than later. We'd rather eat a hamburger or a pizza next week rather than eating it 50 years from now. And so, that can sort of make the spending rate, the optimal spending rate, be a little bit higher. But in any case, I think that sort of lays out some of the different things to think about with regard to this long-term sustainable spending rate. And once you know your long-term sustainable spending rate, or your long-term optimal spending rate, then you can say, okay, well, now I have a shorter horizon, maybe I have a 40-year horizon, and now I can use that optimal spending rate to think about how to amortize my wealth from today, over that horizon. And so, and I'll be spending down my wealth over the whole horizon, and using that optimal spending rate to do that. So it's a tiny bit complicated. It's in, I think, chapter 9 of our book. Chapters 9 and 10 in our book go through it in more detail, but it's not terribly complicated. And I think that the main takeaways are that that optimal spending rates are kind of lower than you think, number one, and number two, that the optimal spending rates depend upon the expected return of your portfolio. So as you go into an environment where expected returns are lower, you have to lower your spending rate, and you can increase it when expected returns are higher. And of course, probably the most important thing is that your spending policy has to fluctuate with that your spending has to be connected to your wealth. That you can't just say, I'm going to spend some amount of money every year, regardless of whether your wealth is going up or down. If it goes down and you don't change your spending, you're going to run out of money too fast. But equally, if your wealth goes up and you don't spend more, then what was the point of taking the risk to begin with, that might have turned out the other way? So it would be very suboptimal to be wealthier and to not have any use for that wealth at all. You should spend more, or plan to give away more, or something. So the spending, there's these different consistency requirements, we think, to good spending policies, and getting the spending right feeds right into how much happiness you're getting, hopefully. It's not, spending money isn't the only way to happiness, but it helps. It helps you to look for it in more places anyway.
But you adhere to, I adhere to it as well, and that is international diversification. So those of us that are older have seen the benefits of international diversification. More recent investors may be wondering, why bother? Your thoughts?
Yes, I think the why bother movement is pretty strong right now. It's been 3 decades, 30 years of U.S. equities vastly outperforming non-U.S. equities. But the idea of international diversification, we think, is a sound one. It makes a lot of sense. Get as much diversification as you can, as long as it's low cost, as long as you're buying things that also have an expected risk premium associated with them. I think that there's been so much said about I think there's been so much that's been said about why to not bother with international diversification. I'd like to just really focus on one point in particular, given that we have a limit on how long we can keep our listeners staying tuned in. So, I think that both Warren Buffett and the late Jack Bogle, the founder of Vanguard, have made the argument that U.S. investors, and maybe they also think that all investors, I'm not sure, whether their argument would also hold for all investors, U.S. and non-U.S., they say should just own U.S. companies. And they say that by owning U.S. companies, that you're getting a lot of international diversification thrown into the bargain. And I think that, I'm not sure of the exact figure off the top of my head, but I think that, it might be that something like 30 to 40% of the revenues of U.S. companies in the S&P 500 come from outside of the U.S. And so Buffett and the late Bogle have argued that, well, look, you're getting plenty of international diversification just by owning these U.S. companies. And, I think there are certain shortcomings in that argument. But one thing that hasn't really been talked about is that if you believe that that is the case, and you believe that owning the S&P 500 is equivalent to owning a bunch of U.S. businesses with like 70% of your investment, and the other 30% or so is basically an investment in non-U.S. businesses, the unremarked part of that, or the logical conclusion for that argument is, well, you're buying these earnings streams from these non-U.S. businesses at the same PE that's being applied to the earnings streams coming from the U.S. parts of their business. But you could buy those non-U.S. parts of the business at a much, much lower multiple. That foreign companies' earnings are trading at a much, much lower multiple, roughly half, versus the multiple that applies to the whole S&P 500. And so if you really believe that the S&P 500 is US and non-US combined together, that you're even paying more for the US piece of it, because the non-US piece, we know what it's worth. We can see the non-US equity markets. Now, there's lots of other reasons why I think that international diversification makes sense. But, I think that that's one that people haven't been focused on that much. Now, you could argue with my conclusion there and say, well, US companies are really good at running non-US businesses. That US companies are much better at running non-US businesses than non-US businesses are. But I would say that I think there's an equal argument that you could make in the other direction, which is saying that, non-US businesses have the full support of their local governments and their populations. If somebody could buy an Apple phone made by a Chinese company, and it looked exactly the same as the Apple phone, and it was even the same price, at some point people are going to be like, well, I mean, maybe the Apple isn't a great example because there's so much of a brand there, but if the same product is made by a US company and a non-US company, and there's not like a big sort of cool branding thing associated with it, that the local populations will have incentives and desires to go with the local manufacturers in many cases. I think that so anyway, I think international diversification makes sense. I think that today international diversification makes more sense than ever.
Yeah, I'm on that boat too. And as they say, if you have a diversified portfolio, you're always going to hate at least one asset class. So that's why you want to be a long-term investor. So my second to final question is, so what is the best asset allocation? We went in the book with a risk level of 2, which is kind of like an average, I guess, risk level. So just give us the cliff notes. How would someone who wants a reasonably diversified portfolio without a huge amount of volatility, because that's why we diversify, is because most of us cannot tolerate our portfolios losing 50% in 1 year. And so we diversify to have a bunch of different assets to kind of moderate those ups and downs, or those downs. So give us just a ballpark of recommended asset allocation.
Sure. Well, what we talk about in the book is that, that we think that investors should take the time to understand and to be able to estimate the expected return and risk characteristics of the things that they can invest in. And particularly with regard to the stock market, it's not that hard. There are places, for instance, Bob Shiller puts on his website the cyclically adjusted earnings yield of the US stock market. You can find it for other stock markets. You can also find it on our website. We show the cyclically adjusted earnings yield of all the different major markets in the world. And so you can take those numbers and think about, that's the expected real return from owning equities, either US and non-US equities. And you can compare it to the real return of a long-term safe asset. We say the best, easiest thing to look at in terms of the real return of a safe asset is to look at the TIPS yield, the yield on Treasury inflation-protected securities. That's published all over the place. You can just Google it and see what that yield is at any moment in time, at any day. You can look at the 10 or 30-year rate, the long-term rate for that. And you can compare the long-term expected return on equities to the safe rate of return on TIPS. And that gives you an estimate for how much extra return you're hoping or expecting to make on equities relative to the safe asset. And that should drive your asset allocation. That should drive how much you want to keep in equities. And you might say, okay, here's my simple little thing. I get a little piece of paper, and on the piece of paper, I just write down, okay, when that number is 4%, let's say, when that number is 4%, I want to have 70% of my money in equities and 30% in safe assets. Let's say when that number is 6%, let's say at 6%, maybe I want to have 100% in equities, or 95% in equities and virtually nothing in safe assets. And when that number is 2%, maybe I just want to have 30 or 40% in equities. And if that number looks like it's at 0, maybe I'll have just 5 or 10% in US equities. And you just make that little chart on one piece of paper, and then you look at what that number is once a year, twice a year, 4 times a year. And then you just see where on that table you want to be, just interpolate your way, just round it out roughly. Then you open your brokerage account, you see where you are, and then you make the changes to your portfolio as appropriate, or move in the direction of those changes. So that's what we recommend, as a good way to do it. In that way, you're connected and engaged with what's going on in the world, with interest rates, with equity returns. You're touching all of it, and you have agency. You're doing it yourself. Now you can have us do it for you too. You can, but that's not necessary. You can do it yourself. And that's what we would recommend. Now, if you don't want to do that, and you don't want to hire somebody to do that for you, then what's the alternative? Maybe the alternative is just saying, okay, I'm just going to put 60% of my money in equities, 40% in fixed income, and I'm just going to let that roll, for the foreseeable future until I get more time to get more engaged with the process of, making these decisions. And if you're younger, if you're in your 20s, you might say, oh, I'll just go with 80% in equities and 20% in fixed income. It doesn't make that much of a difference. Exactly what you choose, but I think the mindset of, okay, if I'm young and I'm not working at a stock brokerage firm or whatever, I'll have quite more in equities and then less so depending on what my job is and how old I am, and you could just choose some ratio. I think it makes a lot of sense to have some money in the equity market. Whether it's on average, if you just randomly chose some day in the future or in the past, I think it made sense to have. It makes sense to keep a reasonable exposure in the equity market at most times. And again, if you don't want to engage with it at all, perhaps be a little bit more conservative. And, so you just say, okay, I'm going to put 60 or 65% in equities. I'll get some exposure there. I'll rebalance myself, once a year, and I'll do that until I find the time to read the book and to start doing it myself. But I think ultimately, investing is not that complicated. That people who say it's like, it's like, it's like trying to figure out how to medicate yourself or how to do your own medical treatment. No. I mean, medicine, being a doctor is so much more involved than understanding how to invest in stocks and bonds. I think just a couple of books, and you'll really be on your way to getting there. A couple of books and interacting with some people that you respect, that have gone before you, is all you need. It just is not rocket science whatsoever, and that's what the good books in finance convey, that it's not rocket science, that it's within the ability of all of us, of everybody, to invest in a sensible way, and financial products have evolved to give everybody a much better chance of financial success than ever before in the past.
Victor, as always, it is a pleasure speaking with you. Tell our viewers, where can they find more about you? Where can they read more about your writings in addition to The Missing Billionaires?
Sure. I think that the main place to go is to elmwealth.com, elmwealth.com. If you get the book, there's lots of links, reminding you about that in the book as well. You could also just find me by typing my name, Victor Haghani, into Google, and it'll probably take you to Elm Wealth, maybe to a wiki page. We have a YouTube channel that has some short videos, including our TEDx talk on the puzzle of the missing billionaires from about 8 years ago. But yeah, I think the website is really the main place. We have lots of articles on ssrn.com, also in various finance journals, but those are harder to access. They tend to be behind paywalls. And there's a number of articles that have been written about us in The Economist, the FT, the Wall Street Journal. But I'd go straight to the source and just go to our website.
Wonderful. Thank you so much. I will put links to everything we've discussed below. Additionally, we'll put links to the book as well. Thank you so much for showing up. I am Barbara Friedberg. This is my good friend and esteemed financial and investment whiz, Victor Haghani. We will see you next time.
Thank you, Barbara. Great being on your show.